All right. Good evening and welcome everyone on this Wednesday night, or if you're joining us on YouTube, uh, welcome. Uh, we have a great webinar for you tonight. It's year-end tax planning for businesses. It's always a popular topic. Um, I am Tyler Henning. I'm the marketing manager here at Provident and Physician Tax Solutions. With me is David Auer, and I usually hand off right now to David Auer to discuss the disclaimer we always have to give on these webinars.
Thanks, Tyler. So what we're going to be talking about tonight are 22 different tax planning strategies or ideas that you might want to consider if you own a business. So what that includes, whether you're a partner in a partnership or you have your own S corporation or you have even Schedule C income. Most of the topics today are going to be somewhat complex, some of which you probably heard about, but almost all of them require following specific rules and requirements to make sure you have your proper business intent as well as documentation to be able to claim the various deductions that we're going to talk about. So none of the conversations or the recommendations we're going to talk about today are intended to result in any penalties whatsoever. Everything we talk about is above a reproach and legal, but you do have to be make sure that you're careful and hopefully working with a skilled and knowledgeable tax advisor.
We always like to walk everyone through our model. It's something we strongly believe in. Has these 5 main pillars that we believe our clients enter into an engagement with us, and they're strong in these 5 points: save, protect, build, retirement, and impact. Then they are well on their way to having a stable foundation for financial freedom, which is the whole reason that Provident CPAs and Physician Tax Solutions exist. Our process to get you where you want to be starts with a strategic blueprint. That blueprint, we look at your last 2 years of tax returns, and we also have you fill out a extensive questionnaire. Not too extensive; it's easy to get through, but there are a lot of questions just so we can make sure that your recommendations are very personalized just to you. Our onboarding process comes next. We have a great onboarding team that is going to help you connect the dots to set up QuickBooks and do some of these other things that will help us implement and also help you have a clear understanding of what's going on. It's a great onboarding team that very dedicated to making sure you understand what is happening with your tax planning and other financials. The implementation process is next. There's steps for all of those 5 pillars I mentioned during in our model. And we wrap up with a quarterly pulse, which is our way of touching base every 90 days, seeing what needs to be adjusted, seeing what topics need to be discussed.
Yeah, and just as a side note, Tyler, I mean, 90 days sometimes seems like an eternity, especially when we're dealing with the current Congress that we have, where everything seems to be changing on a weekly, sometimes even daily basis. So a 90-day action plan is a lot more frequent than most people think is necessary, but sometimes that is, we need to narrow that down to even make that even more frequent to where we're staying on top of things as Congress is coming out with them, so that we can stay ahead with our clients.
The agenda for tonight, we told you in 2 previous webinars, 2 weeks ago and 4 weeks ago, that as things happen in Washington, we are always going to come back and update you and tell you how that's going to affect your tax picture. But the main purpose for tonight is to give you 22 great considerations, tips for your businesses whether it's S corp, C corp, or a partnership. Um, the fun part of this is we found 22 tips, but we have more than 300 that we use and execute and implement here at Providence CPAs.
Great. And then we'll just wrap up with any questions that people have. This is a very critical time of the year where getting year-end tax planning done and precisely put in place so that you can make good decisions. We're already, in the first week of November. Boy, how time flies! But to get tax planning done, it takes about a 60-day time period from beginning to end. So we are already within that crunch time to really start tax planning as it relates to this year. Having information that we're going to be able to share today will hopefully give you some knowledge about what's out there if you're not taking advantage of it. And certainly we are here to help talk about any of these that may apply to you. So first thing we're going to talk about is where we are on the Build Back Better Act. So if you listen to us the last couple of webinars, we've given you somewhat of a state of the union of where Congress was over time. I'm somewhat lack of words to describe what's been going on the last 2 weeks. I thought things were somewhat moving forward with the Democrats in the House of Representatives you know coming up with a final plan, voting on it, then sending it to the Senate for them to consider. However, what we found, if you've been listening to the news or tracking this, is it's somewhat of a 3 steps forward, 2 steps back approach that we're going through right now. So if you remember from last time we talked, we did a little bit of a historic overview of where the legislation and the various bills have been and proposals have been, all going all the way back to the spring. And then right now, what we're looking at is 2 bills. One is the infrastructure package, and then the other is what is called the 3.5 trillion-dollar budget resolution, which is the spending package. So both of those. So we had one of them that was the infrastructure package that had been agreed to by some key senators, and that was then moved to the House pending a vote. But because of the negotiations, the House doesn't want to vote on that until they have a final proposal that the House can vote on, relating to the budget proposal. So as recently last Thursday, President Biden and some key Democrats, so-called, came up with an agreement, which we're finding may not have been the facts, but reached what they call the historic framework, for this domestic policy, the spending plan. The total package was trimmed down from 3.5 trillion down to 1.75 trillion. So what this has done, or what this has resulted in, is a lot of questions that have come up that I want to make sure we address tonight. One is to answer the basic, obvious question: is, are my tax rates going to go up under this new spending plan? The answer is no, which is a tremendous relief based on at least what this framework has revealed. Will my capital gains be taxed as ordinary income? That, as you heard last time we talked about this, capital gains tax rates were going to go up. Now they have been taken off this out of this framework or this proposal. What will happen to my retirement plan? The good news is nothing as of right now, although the writing's on the wall that probably we just kicked the can down the road another couple months, and now into 2022, where there could still be some of this legislation happen. At least for 2021, things look like they're not going to be completed, that are going to cause people to be adversely affected, other than doing things in 2021 that may not be available next year. Will you have to redo your estate plan? Good news is no. We'll talk a little bit more about that. And then what should you do before the end of the year? We're going to talk about that here in a few minutes. So the question is, if the most recent version is passed, and that's a big if, and I really emphasize a big if, because this political football has been going back and forth dramatically, probably more than I've seen in my 36 years of track, being a CPA. So the answers to these above questions are all dependent on this current version going through. Now, keep in mind, there's a lot of moving parts. Um, the good news is we've narrowed it down to where most of the tax increases that were being proposed are eliminated from the House version. Keep in mind that we haven't yet addressed the Senate version of this bill, which is going to be forthcoming once this gets passed by the House. Then the Senate will have their version. Then it'll have to go back to joint committee to work out the differences. If we look at do a closer look at the details that have changed, there now looks like the House is proposing a 15% minimum tax on large corporations. So these are ones that are over $1 billion in profits. And there's a 1% surcharge, for these companies that buy back their stock. For very, very high income individuals. So these are people that have income over $10 million. There's a proposal for a 5% surtax, an additional 3% on income or adjusted gross income over 25 million. So that is dramatically changing the landscape of had been in the earlier version. And then the one thing that will probably affect a lot of our clients that currently have partnership or S corporation income through businesses that they materially participate in, there's going to be this new 3.8% net investment income tax, which unfortunately is a little higher than the Medicare tax that a lot of clients are in. Once you get over the FICA wage base, and with your salary, so there are definitely some planning opportunities that will help mitigate the effect of that 3.8% tax that we'll talk about. That's going to hit individuals with income over 400,000 and joint filers over 500,000. Couple other provisions. Right now, we have a 175% and 100% gain exclusion for the sale of corporate stock from qualified businesses under Code Section 1202. That has been in effect since 2018. It increased from the previous 50% and 75%. So the proposal in this latest version is to reel that back down to the 50% gain exclusion. It's still attractive if you otherwise qualify, that you don't have to pay tax or for the full capital gains tax on the full gain, but you get a 50% exclusion. However, it does have an effective date of September 13th of 2021. So limits a little bit of being able to take advantage of that. If you otherwise would have qualified between now and the end of the year, you'll fall under, if this revision becomes the final bill, it will have an effective date that is in 2021. Excess business losses from non-corporate business payers or taxpayers, with where you can't carry over any disallowed losses. That doesn't apply to a lot of the individuals, but it could apply to certain types of businesses. Cryptocurrency, as you might have read, is coming under some scrutiny. They've proposed adding a couple of tax principles or rules, limitations on how to take losses and transactions on relating to wash sales and constructive sales with cryptocurrency. So if you deal with a lot of cryptocurrency, that'll be something to watch as this bill progresses. Probably the other important item that certainly rings home to us, because we're constantly sensitive and aware of the audit risk that our clients have, and always trying to make sure that our clients stay off the radar. And so right now, it looks like there's a proposed funding of about $80 billion over 10 years to allow the IRS to ramp back up. So quite frankly, we've been in a window probably for the last 10 years where due to understaffing and lack of technology, audits from the IRS have been probably at a historic all-time low. So those days may be over. With that said, this new enforcement will probably be aimed at the higher income taxpayers. So those are businesses or individuals that have over $400,000 of income. So I do have some statistics on a couple of things. One is, as of about a month ago, there were still over $7 million of tax returns from just the most recent tax year, 2020, that required manual processing. So the IRS is right now understaffed to even process the tax returns from 2020 and to issue refunds. So you might be one of those unlucky individuals who are still waiting on a refund from 2020. There's not much that anyone can do, even if you were lucky enough to get through to the IRS, which right now has about a 9% chance that you'll even get a live person on the other end. And this is after spending probably hours on the phone on hold. Um, we experience that a lot of our calls when we're on hold with the IRS actually get dropped after waiting for 3 hours. So very frustrating. And once you even do get an individual, generally they're not going to be able to tell you any more information than what you could otherwise you'll get online by with the IRS's website to check your refund. If you're expecting a refund from prior years, there's currently over $16 million or 16 million tax returns from 2019 that are still awaiting manual processing. And if you've amended your return, you're probably even more out of luck, because those are the last ones to be manually processed. And there's almost 3 million of tax returns still waiting to be manually looked at by somebody, a human being at the IRS. We've experienced a lot of inaccurate, a lot of inerrant notices coming out of the computers that the IRS have. It's very frustrating because people get a notice and they think they've done something wrong. And reality of it is this, the IRS, which I might beg that the Internal Revenue Service should use the word service in their name, but they are certainly behind time or schedule to keep up with everything. There's no telling, even after the funding of this 80 billion, how soon they're going to be able to catch up. So one strategy that we typically recommend with our clients is generally don't try to overpay your taxes if you're expecting a refund, but try to be as accurate as you can in what you owe so that you aren't sitting there waiting for a check to come in the mail, which could be a couple of years. So I'll get off that uh, soapbox, but some other areas that may be of interest in this new proposal is in the area of energy tax credit. So those of you who are looking to make investments either in energy efficient improvements to your home and or to buy an electric vehicle, there is part of this new proposal is to give some tax credits, some subsidies for that, and then depending on battery capacity and whether or not the battery cells are made here in the U.S. One group that I talked to said that it's not just in the U.S., but it needs to be manufactured by an organization, a company that is union based. Anyway, there's some energy credits that could be part of this bill. I'll talk a little bit more about that in the recommendations on how perhaps to take advantage of that. A couple of the most glaring things that were not in this, in the previous version, there was going to be an adjustment to the exemption from estate taxes and gift taxes. Right now, that was, and under current law, that's right now at about $11.7 million per person. So a married couple, just over 23 million. State tax really didn't worry most people unless you were over that net worth or taxable estate level. That it was proposed to come back down to 5 million adjusted for inflation, which would hover right around 6.2 million. That got taken off the table, which is a surprise to a lot of people. Because again, a lot of the tax revisions that seemed to survive were targeted to the ultra wealthy and the very large corporations. So the fact that the estate tax exemption change got taken off the table was a little bit of a surprise to me. However, keep in mind that was already scheduled to be reduced back down in 2026. So it was just a timing difference on what year. And again, that only really matters if you're entering into some kind of a wealth transfer transaction with your family members and or you happen to die with a large estate before that exemption was otherwise going to go down. Another area that was a relief to a lot of estate planning attorneys and a lot of wealthy clients was the proposed elimination of a lot of the strategies that are used in wealth transfer, including certain types of trusts, And then also, exchanging property between, you know, uh, grantors and trusts, without having to pay tax. And then a big relief to corporations, and these are tax-paying corporations, was the current 21% rate was projected to go up to 26.5%, with a couple of with a surtax for the larger, more profitable businesses. That went away. That got taken out of this, as well. With that said, there was a proposal that beginning tax rate was going to be as low as 18%, which actually could have helped most of our clients who use C corporations, for some of their, in their tax planning. And I'll mention that, here in some of the recommendations that we have as well. And then, obviously, keep in mind that these negotiations are ongoing. It almost is on a day-to-day basis. You'll hear multiple people in Congress saying different things about how likely or unlikely the bill, has to be passed. And then obviously you then have all of the color commentary, that people, inject on top of that. We do not, uh, have concluded that just because these proposals have been taken out, that means that they won't be, put back in at later during, further negotiations. There seems to be a very big motivation to try to get something passed in the House, as stripped down as it can be, voted on. Um, I've heard as early as this week, although I think that's unlikely, but by the Thanksgiving, holiday. Our belief is that it's much better to do planning based on the current law. If we have better, indication that, things are going to happen, we can take those into account. But we just, it's virtually impossible to predict what the future is going to be. And that goes all the way back to, some of our webinars back at the end of last year, right after the presidential election, and what we were, getting information on about all the pending changes that were going to happen tax wise. Here we are, virtually a year later, and there has been very little actually, that's been finalized. It's still all, being negotiated. So tax planning is a year-round activity, for firms like ours. We pride ourselves on doing that and staying ahead of the game, trying to see, where the puck is going, as, Wayne Gretzky once said, rather than where it is right now. So our job is to constantly, stay up with what is going on in Congress, but then try to interpret what that means, to our clients, and how best to advise them. So let's transition, into some of these, year-end tax planning. Like Tyler said, we have over 300 tax planning strategies that we have in our tool chest right now, that we pick and choose what applies to, our clients from, based on their situation. However, we've narrowed that down to about 22 that, we think you can still get, put in place this year, regardless of what the tax, bill is, this year. And some of them do depend on perhaps what, Congress passes. So I want to talk a little bit about, those, but, just good, blocking and tackling with, year-end tax planning, still makes sense. And the temptation is to just get this paralysis effect of not doing anything because Congress hasn't acted. And that could be detrimental if you don't do anything when, you otherwise, are facing a fairly sizable, tax situation, this year. So, let's first talk about, and I broke these down into the type of clients that we have generally. So this first category is really for clients that have 1099 income as independent contractors, or they might have, they might be currently reporting that income, or they might have a side business where they have, income that they report on their Schedule C on their 1040. So, in light of what we currently know, which is, tax rates right now, may not go up for individuals. If everything else being the same, if you believe you're going to be bumped into a higher tax bracket next year, versus where you are this year, it behooves you to see if there's ways for you to accelerate some income that you otherwise would wait until 2022 to recognize, push that into 2021. Sometimes that's hard to do with income. However, on the flip side, And it may be possible to prepay some expenses if you're in a higher tax bracket uh, next year, or I'm sorry, postpone some expenses that you otherwise would pay if you think your tax rate is going to go up next year. At our next webinar, dealing with individual tax planning, I'll go much more into how to manage your tax bracket and know exactly where you are so that you can make that calculation to see if it makes sense to wait on paying deductions until next year. On the other hand, if your tax rate's going to go down next year because you had a big income year this year and it's out of the ordinary, then probably it behooves you to prepay those deductible expenses this year, and to the extent you can, defer that income into next year. So that's a first tip for generally everybody out there that has income and has control over whether they report their income this year and incur that deduction this year. The other area which we often come across is we still have a lot of our new clients that come to us. They're doing locum tenens work, or they've got a side business where they're getting Schedule C income, and perhaps at the first 10, 20, maybe $30,000 in net income, it doesn't really there's not really much to do that would justify any significant changes, but you pass a threshold where you're going to start having to pay a fairly sizable amount of self-employment tax or Medicare tax. So in that situation, if you are feeling the pain of paying self-employment tax, looking into setting up an S corporation, that could be an limited liability company that elects to be taxed as an S corporation under federal tax law, may make sense going into next year. Another area that we feel is very underutilized because a lot of our clients just don't know what they can take advantage of is maximizing your home office deduction. The IRS gives you a couple of different ways to do it. A lot of people, without knowing better, calculate it based on gross square footage of their office compared to their house. You can use the net square footage, which means that you can exclude all of your common space. And if your businesses, or if your vehicle is used for business, you can include your garage in that area. So anyway, it could be a small effect, but definitely it could make a difference over the long run by just using your net square footage. If you have the opportunity to, with cash flow, to be able to put us, if you're married and have a spouse or partner, put your spouse on payrolls so that you can make a contribution to their retirement plan. That would be something else you could do, when you're a Schedule C or a 1099 business. And then something else to think about doing. There's some limitations on how much you can do due to the age of your children and what they do, but to consider putting your kids on and or your parents, if you're financially supporting them, so that you can shift income from your higher tax bracket down to their lower tax bracket. And then another strategy for 1099 is just make sure that you're getting the most out of your vehicle, your business meals, and any kind of travel expenses that you otherwise could take on your business tax return. A lot of people are not out there fully knowledgeable about all the things that they can deduct. So there's a laundry list of things that you can deduct as business expenses, and the key is just knowing what you can and can't deduct. And then another strategy here, but it depends on whether this final proposal becomes law. And I'm not a big proponent of purchasing a vehicle just to get a business deduction, unless you otherwise need to buy a vehicle. But if you are attracted to maybe buying an electric vehicle, and we've got this potential energy tax credit that is part of this new bill, and I think there's a lot of momentum to keep that credit in the bill. You might, if you're interested in buying one, if the bill becomes law this year, or wait till next year when the law is effective to pursue or to buy an electric vehicle. If it's used for business, you get a higher tax credit than you would if it was individual. But you also get to depreciate that vehicle, whatever you don't claim as the credit. So anyway, it could be a win-win from a tax credit and a write-off standpoint to buy an electric vehicle. And then, a lot of clients don't know that something that's called bonus depreciation is out there. Any assets or business property that is classified as 3, 5, 7, or even 15-year real estate improvements qualify for the 100% bonus depreciation. Um, According to the Tax Act of 2018, 2017, actually, 15-year property was not specifically mentioned in that bill. Congress came out and clarified earlier this year, actually at the end of last year, that 15-year real estate improvements do qualify for the bonus depreciation, which was a big relief for a lot of clients. If those of you who happen to own real estate, a significant investment in commercial or residential real estate, doing a cost segregation study would allow you to identify how much of that of your original cost of that building or real estate improvements would potentially qualify as a 100% write-off this year. In lieu of a 100% write-off, at least you get to accelerate that depreciation out over the useful life of that specific asset, which a 3, 5, 7, 15 years is a lot better than a 27 and a half or a 39-year depreciable life that a lot of commercial and residential real estate is subject to. So let's move to some recommendations or considerations if you already have an S corporation or are a partner in a partnership. So under this new tax bill, if it becomes part of the final bill that is signed into law, any interest you have in an S corporation or a partnership in which you materially participate is going to be subject to an additional 3.8% net investment income tax. So it's an attempt for Congress to get around some of the tax planning that S corporation shareholders have been able to take advantage of in the past, which is keep your salary as low as reasonably possible out of your S corporation, take the rest of the profits out as a distribution of profits, which means that you don't have to pay FICA and Medicare tax on the distribution of profits. So there's, you need to still have a reasonable salary out of your S corporation. However, when you now have an S corporation that you materially participate in, to the extent that it's allowed by state law. So if it's a professional entity, and if you have a spouse that is not able to own a interest in a professional entity, you may not be able to do this. But if you any other S corporation in which your spouse is not materially participating in, it may behoove you to shift some of that ownership over to them. And at the end of the day, if you still file a joint tax return, you at least can have the income that is going to the non-materially participating spouse not be subject to that 3.8% tax. So anyway, that's something to keep in mind as we watch this bill go through Congress and the Senate. Another popular strategy that we generally always recommend to our clients who have a fairly high amount of income coming through an S corporation is to look, for a business purpose to have a C corporation. There's a number of different types of C corporations you can set up if you don't otherwise have another business that's a candidate. The biggest reasons for doing that is to give you that to be able to tap into over 25 different fringe benefits that C corporations can offer to their owners, shareholders, and employees that an S corporation can't provide on a tax deductible basis. And if nothing more, allows you to shift income now down to the current 21% bracket, marginal bracket. So if your income is above your individual income is above tax rate is above 21%, it allows you to shift income down to potentially that lower bracket. Another popular strategy is what's called the Augusta Rule, which is having creating a situation where you could lease your home to your business and use your business for up to 14 days. And what that allows you to do is to deduct that rental cost as fair rental value as a deductible business expense. But under the IRS rules, any rental income for 14 days or less is not included in your personal tax return. So it allows you to claim a deduction at the business level, but not have to pay that income tax on that rental income. And then, always keep in mind when you have an S corporation, we have a lot of clients that don't do this. And so we have to remind them. And usually this is done at the end of the year if they haven't had enough reasonable compensation paid to themselves out of their S corporations, is to have a reasonable compensation study done. That's what we do for all of our S corporation clients, where you identify what ranges based on the facts and circumstances of that S corporation are considered to be arguably a reasonable compensation. That goes a long way to reduce the risk in an audit that the IRS says that you have not paid yourself enough for a reasonable salary if you've conducted a study to show what, based on the circumstances that happened that year, what is considered reasonable. So anyway, always keep that as a to do when you're entering into the end of the year. And you have an S corporation where you have not perhaps taken out enough W-2 salary out of your S corporation. And again, if you haven't paid yourself a reasonable salary and you just have an S corporation that you take out as distributions, keep in mind that the IRS's statute of limitations on payroll tax returns that have never been filed is they can go back into perpetuity all the way back to the beginning of the business. So there is no statute of limitations. Unlike generally the general rule of a 3-year general statute of limitations for an audit. If you haven't been paying yourself a reasonable compensation, it could turn out to be an absolute nightmare. If you get audited, they determine that 100% of your distributions were W-2 income, subject to FICA and Medicare tax, and they go back every year you've been in business to assess that tax. That could be a devastating result. If you haven't already, this was what we thought was going to go away under the previous bill, but it's still around. Look at either doing a backdoor Roth IRA and or a mega Roth 401k, which allows you to basically put as much as $57,000 away in a combination of a Roth 401k plus through a profit sharing plan, and then immediately out to your Roth IRA. So that is something that if you're concerned about future tax rates and you want to get as much contributed to a Roth IRA or 401k, while you're before tax rates go up, that's something to certainly consider doing. And then another popular benefit for the S corporation is to adopt a medical reimbursement plan or accountable plan. Allows you to reimburse yourself for any out of pockets, co-pays, those kind of things that you spend on medical expenses, and above and beyond your, deducting your insurance premiums, your health insurance premiums. You can't. The only downside is you can't combine a medical expense reimbursement plan with a health savings account. You can't double dip and contribute to both. So if you don't have an HSA because you don't have an eligible insurance policy or haven't set one up, you might want to consider a medical reimbursement accountable plan. And then a very popular strategy, especially of late with the fear of tax rates going up, is looking into a restricted property trust. This is an alternative to a traditional retirement plan where you can deduct approximately about 70% of your contribution every year, but the principal grows tax-free. And it actually has then a self-completion benefit, death benefit. If you happen to die before you get to retirement age, it has a lump sum payment that you can have paid to your family. So if you haven't looked into restricted property trusts, that's something that we generally look at as a consideration with our clients who otherwise might be eligible for one. The downside to a restricted property trust, it's about a 60 to 75-day due diligence or time period application process. So we are now in that window where if you're going to consider that for 2021, you need to get really started on looking at that sooner rather than wait anymore until later in the year. And then the other strategy I want to talk about at the S corp and partnership level is that if you live in one of those lucky states that have made an election to allow your S corporation or partnership to pay your state income tax liability as it relates to your S corp or partnership income, you definitely want to take advantage of this. So where this is going to help you is, as you may remember, after 2017, starting in 2018, your state and local property and income tax is subject to an overall cap of $10,000, assuming you itemize your deductions. So we have clients that live in some very high income tax states and or property tax states that always pay well over the $10,000, and unfortunately they can't deduct that excess. However, if you live in one of these states that allow you to make an election you can pay that your state income tax from your S corporation or partnership and deduct it as a business expense dollar for dollar. There are certain requirements that you have to follow depending on what state you live in. But that is definitely something that you want to put in place, not only from an election standpoint, but also pay that state income tax by the end of the year so that you can deduct it as a business expense. So here's a map. This is a earlier last month that this was created. Which states, first of all, don't have an income tax, so you don't have to worry about it. Those are the ones in gray. We have several states that where they have already passed this where the election is allowed. Some of which require don't aren't effective until next year versus this year. So those have been footnoted on this map. And then a couple other states where the requirement or the election, the request for the election is mandatory for it to be able to apply. And then we have a couple of states that are looking at it. They've got proposed bills. By the way, as of right now, I'm aware that Michigan or Massachusetts has passed their bill to allow S corporations and partnerships to make that election to pay the state income tax. So if you live in one of these states that is in blue, and or some of the states that are the bill is either proposed or most recently just passed, you definitely and you have an S corporation or partnership that has positive income. This is probably one of the smarter decisions you can make this year is to get that election filed and make your state income tax paid at the entity level, not at the individual level where you otherwise would have that cap. So the last part I'd like to talk about is some additional tax planning for some of you who may have even more income and or some of the larger businesses out there. One of my favorite tax strategies is what's called a closely held captive insurance company. It's basically a device or a tax law that allows small businesses to self-insure risks that they otherwise don't have a commercial policy to cover. Obviously, these have been abused over the years, so the IRS is looking at these. If you want to do this and abuse, what the rules are, I certainly wouldn't recommend it. But these are very legitimate tax planning strategies that a higher income business who has the extra cash flow that they can afford to shift over to a closely held or privately owned captive insurance company to self-insure some of that risk would be very beneficial. If you set it up to where that corporation is owned by your Roth IRA and or your Roth 401k, it's what I call a tax unicorn, meaning that you get to deduct the premiums that you pay over to the insurance company. But when you ultimately liquidate it, assuming you're over 59 and a half through your Roth IRA, there's no tax on the back end. So it can work out very, very well for those business clients that have enough income that they can set one of these up. But then very, very attractive if you can have it owned by your Roth IRA or 401k. Another strategy for higher income clients is always look at all the entire alphabet soup of retirement plans out there. I jokingly say alphabet soup because there seems like there's dozens of them nowadays. Just make sure you've got the best combination. Ones where you can either deduct the contributions going in and optimize access to that money as it grows and manage it, but then more importantly, how it's going to be taxed on the back end. So if you can look at optimizing as much tax-free future income that you can have through these retirement plans, and then to the extent that you can control your future distributions coming out of the taxable portion, you can create kind of an ideal combination. And if you do have a defined benefit plan, you might want to look into supplementing it with what's called a 401h plan. So this is basically like a health savings account for future medical expenses or healthcare expenses when you're retired. But it allows you to contribute potentially a significant amount more than you ever be able to put into your HSA. If you do take it out, and the contributions go in tax deductible also. If you do take it out for healthcare during retirement, it's tax-free, much like an HSA. If you end up not needing it for healthcare, but you just take it out as a distribution, then it's taxable just like a normal distribution from a tax-deferred retirement account. And then another tip is, like I mentioned earlier, it looks like under this new bill that the 100% gain exclusion, if you have a Section 1202 corporation, if you sell that stock, you can avoid right now up to 100% of the gain, up to $10 million of gain, or if this proposal does go through, at least 50%. So I still think it's beneficial to look into setting up a Section 1202 corporation, just so that you can, especially if you have a business that you plan to sell, 5 years or later in the future. Definitely have this as another, card in your pocket that you can play, and hopefully avoid paying tax on the 100% of the gain. And then another popular strategy that we have, this is now becoming an alternative to doing a Roth conversion, especially if you have $1 million or more in qualified retirement assets or tax deferred retirement assets, is to look at potentially contributing money to a family endowment plan. I've talked about this in prior webinars. Certainly, we can do an analysis for you to see if this is feasible. It also is a very good strategy if you're planning to sell highly appreciated assets, whether it's a business or real estate that you're otherwise not going to do a 1031 exchange for. So these have become very popular here in the last couple of years, but not a lot of people know about the family endowment plan. And then the last suggestion I'd like to mention in our time that have tonight is make sure that with your tax advisor, you are, and this is really probably a good exercise to do almost every year, especially if tax laws are changing, is always reevaluate whether or not you have the right business entity set up. Because as tax rates ebb and flow based on the different types of entities you have, it may there may be times where it doesn't make sense for you to have the entity that you in the tax structure that you had originally when you set it up. So as a just a, com- a good practice to have on a regular basis is, especially in changing tax laws, is make sure that you've got the right combination, and that your businesses, each business has the appropriate tax structure. Uh, so multiple factors go into that, but I would certainly make sure that you are aware of what are all the types of entities out there, and what one entity might do better than another entity, depending on your tax situation. So that wraps up our 22 tips or recommendations. These are some of the hot buttons that we deal with our clients. Like I said, there's hundreds of more tax strategies that we pull out of our the bag whenever they're needed for a particular client situation. So every situation is somewhat unique. And so starting with a good tax plan is usually, our best way of showing, clients or prospective clients what they can do, and what, based on the next, year to several years, depending on their financial situation. So Tyler, I'll turn it back over to you to wrap things up with our process and to announce our next webinar.
All right. Before I dive back into our process and recap that, I want to take this opportunity. We have one question in. If you have questions from the 22 tips and considerations that you just heard, now's the time to get that in. We're just a few minutes away from that question and answer period. If you're new to us and you haven't had or entered an engagement with us, this is our process. It starts with a strategic blueprint, which is looking at your 2 years previous tax returns and having you fill out a questionnaire. From that, we drill down and get some very personalized recommendations for your situation. After that, our team, after the strategic blueprint, we'll hope that you will trust us and allow us to help implement those recommendations. If that's the case, and we decide it's a great fit for us and you, we'll enter into onboarding period, which is a great educational time, and a time to really get to understand how things work with your tax situation and your path to financial freedom. We'll implement the strategies that we come up with and try to help you be really secure and strong in those 5 pillars that we discussed earlier. And our team will always reach out to you uh, on a set schedule to make sure those action plans are working the way they should. There's two ways to really get started with us. The slowest way, if you're just kind of want to dip your toe in the water and see what we're all about and ask some more questions, is a 30-minute no obligation call. Uh, Tomorrow, if you register for this webinar, you'll receive an email that has this link. If you're watching this on a YouTube recording, it'll be down in the description below the YouTube video with that link to schedule that 30-minute call. If you're very interested in going straight to the strategic blueprint, we have a method for that, but there's a couple caveats. We only have about 20 blueprints that we can do by November 15th. It's the end of the year. We're doing year-end tax planning for a lot of our clients. So our tax team can really only accommodate about 20 of these blueprints. It does take some time from our team to crunch the numbers and look at your questionnaire and your tax returns to come up with the proper recommendations. The great thing is we guarantee a finding of 10 times the cost of the blueprint in your tax savings. I've seen some of these strategic blueprints get presented to clients. I'm always amazed at the tax savings that is usually presented. It's just an interesting process and great value. Upcoming webinars.
And just real quick, Tyler, if you'll type in the chat box, those links, so that if somebody wants to go ahead and click on them while we're talking here in the last few minutes, they can go ahead and click on scheduling a call or access the blueprint.
Sure thing. I'll put those in the chat right now.
And as we had mentioned earlier, we've got one more webinar that we've scheduled. We're gonna potentially have another one after this if the final bill out of Congress doesn't get finalized by our next webinar, just so that people know what is out there and what they might still be able to do by the end of the year, if anything. So we've got our last webinar of the year for 2 weeks from tonight. It is going to be, the time changes from our current time is 7:30 Central to 4 o'clock in the afternoon Central Time. Again, probably as most of our participants do, they register for the webinar and then watch it on their own time rather than just live. So I'd encourage you, if at a minimum, register for it, and then you can watch it when you have time. And we are going to roll out a schedule for 2022 webinars. We're in the process right now of identifying what are the topics that are most important for our clients and prospective clients to know about. And again, we are in this constantly changing tax environment. So we're going to be trying to stay on top of whatever legislation is out there on a current basis, so that you can know what you need to do to take advantage of it.
All right, David, we have one question. It popped up during the reasonable compensation study tip. It's from Martina. She asked, does retirement plan contributions to profit sharing or defined benefit plans count towards reasonable compensation?
So the way I'll try to explain it this way. So the lower that we can make your net income from your S corporation, take into account all of the ordinary necessary business deductions that we can come up with, including potentially shifting income over to a C corporation for services that the C corporation offers to the S corporation. So our first goal is to write off everything that we can that's allowable for your S corporation. That lowers your net income. What also lowers it is your contribution to the retirement plan, which is somewhat a function of your W-2 income, depending on what type of retirement plan you have. So they're interrelated, but the bottom line answer to your question is the contribution to the retirement plan is taken off out of your net income, which then lowers your net income. That then, based on that net income and your industry, is taken into account to establish what that reasonable compensation is. So everything else being the same, if your net income from your S corporation is $500,000 after you made a contribution to your retirement plan versus 100,000 or $150,000, you would you would need most likely to pay yourself a higher W-2 with a net income of 500,000, which means you're going to paying more potentially FICA and Medicare tax. If we can lower your taxable income because of all the other deductions down as low as 150,000, which there's I'm not promising that, but just as an example, your W-2 that you have to pay yourself is a whole lot less because your net income it was a much lower number. So they are interrelated to answer your question.
All right. I think that is all our questions for tonight. If you're watching this on YouTube, there will be a whole bevy of links underneath in the description. And if you register for this webinar, look in your inbox tomorrow morning for a copy of this presentation, as well as the deck and some critical links that you might want to know about, including the link to that next webinar on tax planning strategies for individuals. So I'll sign off. David, you want to tell our crowd good night?
Yeah, thanks everyone for your time. Those of you who are listening live, if there's anything we talked about that you have questions about, certainly feel free to reach out, schedule a call so we can address your questions. Time is of the essence as we're moving quickly to the end of the year. We will hope that everyone listening to this will sign back up for the webinar here in 2 weeks, and we hope to have further updates on where Congress is. So thanks everyone, and hope take care, especially as we get into the colder days of the winter.